Retirees often have a lot of questions about taxes in retirement. So in today's video, we are going to talk about 10 questions that retirees have about taxes that they actually often get wrong.
So in retirement, Amber, taxes are a little bit different than when you're working, right? You've been working for 20, 30, even 40 years. You kind of have that tax game figured out. Things do change in retirement. So we're going to go through these top 10 questions to see how we can help our viewers.
So question number one is, when you retire, is your tax rate going to be higher or lower than it was when you were working?
Now, obviously, Amber, this depends on the individual situation, but most of the people we work with are not, I repeat, they are not in a lower tax bracket in retirement than they finished in their working years. And there's 3 reasons for that. First of all, the deductions are gone, right? Kids are gone, you no longer have the child tax credit. You were getting a deduction for putting money into your 401k plan. That's gone. Mortgage interest, if you got to deduct that, it's probably nearly paid off, if not already paid off. So the deductions are gone. That's the first reason. The second reason is retirees want to have fun, right? When we're working with clients, we say, how much do you want to have for income in retirement? Most people are saying, I want it to be very similar to what we're living on right now. So they don't want to take a step backwards in lifestyle when they retire, at least not initially. And that takes a lot more money and that takes more income. And the third reason that your tax bracket probably will not be lower in retirement is because taxes are on sale right now. We have some of the lowest tax rates in our country's history, and they are already scheduled to go up on January 1st of 2026. So most likely brackets will be higher in the future. So that's 3 reasons why your tax bracket will not probably be lower when you retire.
So what does this mean for tax planning?
Well, it means you've got to figure out what your income plan, right? How much income do you need in retirement and what sources to pull from? Do you want to pull from IRAs versus Roth IRAs? When do you want to take on Social Security? We'll talk about that in a minute too. So there's a lot of planning that goes on here to try to minimize the taxes in retirement.
The second question is a really common one. And like you said, it's about Social Security. And the question is, are Social Security benefits taxable?
Yes, absolutely, they are taxable. Now, here's the rule of thumb. If you have other income besides just Social Security, so you're going to take from a 401k or an IRA, or you have a pension, most likely you're going to be paying taxes on either 50% of your Social Security benefits or 85% of your Social Security benefits. So that's the good news. While benefits for Social Security are taxable in retirement, they only tax 85 cents on the dollar, worst case scenario. But Amber, if a viewer only has Social Security income, that's all their only source of income in retirement, nothing else to pull from, then they may not pay taxes on their Social Security benefits because they fall below those income limits. One thing to note, Amber, is people who have tax-exempt interest, think muni bonds primarily, right? This is not taxable for income purposes, but it is included in the calculation to determine how much of your Social Security benefits will be taxable.
Question number 3 is, can you still contribute to an IRA after you retire?
This is a change, Amber. Yes, now you can. Since 2020, the tax law changed, saying as long as a retiree has earned income, so think W-2 or 1099 business income, then they can contribute to an IRA or a Roth IRA. This used to be at 70.5. It was turned off whether you're working or not. Now, we'd love to talk about the hybrid retirement. So maybe viewer retires from their 9-to-5 job and does some part-time work for something to do. They can still contribute to an IRA in that case.
So this is really applicable to those who are still working part-time in retirement.
Yeah, if you're totally done working, no other income, then no, you cannot contribute. However, you can convert from a traditional IRA to a Roth IRA regardless of whether or not you have earned income from a job or not.
Question number 4 is, are withdrawals from Roth IRAs tax-free when you retire?
The answer to that is yes, so long as you meet 2 criteria. Number 1, you have to be over age 59.5, and number 2, the account must have been open for at least 5 years or more to get that tax-free status from the Roth IRA.
So that's something you want to start planning then before retirement.
Oh, absolutely. And we mentioned that in one of the first questions is, when do you pull from which account, right? Speaking about your income plan, when do you want to pull down from your Roth IRA versus your traditional, and some of that advanced planning techniques to minimize taxes in retirement? It's not just, I'm going to pull from this account and be done. It's a little more complicated if you have multiple types of taxable accounts.
Question number 5, are post-retirement rollovers from a 401k plan to a traditional IRA tax-free?
Yes, if done correctly. So there are 2 ways to do this correctly to avoid the tax. The first and the preferred method is to do a direct rollover from custodian to custodian. So if one of our viewers retires, They have an advisor like me say, okay, let's take this 401k and put it in your IRA so you're in charge. We call up the 401k custodian and they send the money directly to the IRA custodian, the new IRA. That's the preferred method. The second method is you can do what's called an indirect rollover, where the 401k sends you the check and then you have 60 days to send it into an IRA to avoid the taxes. There's a lot of hiccups in that. A lot of things can go wrong. And we have seen some people, unfortunately, get stung by that if we didn't help them do it. So I don't suggest that. I suggest the direct rollover. And when it's done that way, no taxes until the money comes out, Amber, right? So if you move a $500,000 401k to a $500,000 IRA, that's not taxable. But then you pull 50 grand out for the income for the year, that's taxable.
So then the income from this is taxable?
So the question is the rollover taxable? No. But once you take money out, just like any IRA or 401k, then it's taxable at that time. So once you get your hands on that money, it's taxable at that point. The process of the rollover is not taxable. Just the income you receive, if any, right? You could roll it over at age 60 and not take anything out for 12 more years. It's not taxable until you take it out.
Question 6. Is the income you receive from an annuity you own taxable?
Yes. And it depends on what type of annuity. So there are really 3 different ways the annuity can be taxed, Amber. If you took money from an IRA or 401k and put it into an annuity, it's still an IRA. So every penny is taxable, right? Every penny that comes out of there is taxable. But say you had some money left in savings, maybe in a CD, and you put that into an annuity that's with after-tax dollars. Now just the interest or the growth on that annuity is taxable. But how you pay tax on it is now subject to 2 different rules, okay? The first rule is what's called LIFO, last in, first out. And the second is the annuitization rule. So let's explain those. Say that someone puts $100,000 into annuity, it grows to $120,000. They take out 10 grand for income that year. Well, it's LIFO, it's last in, first out, and they're gonna pay tax on the first $20,000 that comes out as interest, and then it's principal, not taxable. With me so far? Mm-hmm. The annuitization rule is different. So in the same example, say $100,000 goes in, it's worth $120,000. Now the viewer calls up the insurance company and says, send me payments for the next 10 years. Well, now the insurance company is going to take that $20,000 of interest and they're going to calculate it and they're going to prorate it over the entire 10-year period. So now the interest is taxable over 10 years instead of interest first. So there's really 3 ways that annuity can be taxed, and these can be confusing. So it's really important to work with somebody who can help you with this.
Question number 7. At what age must holders of traditional IRAs and 401ks start taking required minimum distributions, or RMDs? Now, this is something that has changed very recently, and we've done several videos on this.
Right, it changed in 2020. So now, as of today, you must be 72 before those required minimum distributions kick in. However, if you were 70 and a half before January 1st of 2020, then you're still under the old rules of 70 and a half. But as of today, it's age 72.
So our next question, question 8, is a follow-up to that. And that is, when do you have to take your first RMD after you turn 72?
Well, you don't have to take it, Amber, until April 1st of the year following the year you turn 72. But I don't recommend that, and here's why. If someone turns 72 this year and they take out their RMD next year in February to count for this year, they still have to take next year's RMD as well. So now you're paying tax on double the income, right? Most of our clients, when they turn 72, we are taking that first distribution in the year they turn 72 rather than delaying and having to take 2 the following year.
So question number 9 is another RMD question, and it is, are RMDs calculated the same way for distributions for multiple IRAs and multiple 401k plans?
The answer to that is no, and this may be surprising, so we'll have to walk through it. If a viewer has, say, 2 or 3 IRA accounts, we take the total on December 31st of all of them, and that's the RMD that's required. You can be pulling that from one account only. So as long as the RMDs total for all 3 are pulled out for the year, that's fine. 401k plans are different. So let's go back to that. Say that a viewer has 2 401k plans, a former employer plan and the current employer they are retiring from. The RMD must be taken from each of those 401k plans. Now, if they roll those into 2 separate IRAs, then we could use the IRA rule. But as long as they're 401ks, they have to have an RMD from both plans. So it is a little confusing. Again, really important to work with someone who knows these things.
Our final question, question 10, has to do with life insurance. If your spouse dies and you get a big life insurance payout, will you have to pay tax on that money?
No, whether it's big or small, right? Life insurance proceeds are not subject to income tax. And that's a great reason to maybe have some sort of a small policy, even for covering funeral costs or some unexpected, maybe you want to clear off that mortgage debt at the end. So there is a good reason to have life insurance. That's the number one reason. Tax-free income for the surviving spouse.
So if you need any help with any of these tax questions, you can go to workwithnewgen.com and schedule a 15-minute phone call to speak with us.
Because you can make the rest of your life the best of your life.
Plan now to retire happy.